Hi and welcome back to this order flow mastery course by Deep Charts. In this video we're going to take a look at Order Flow Tools 104 Deep Profile or Volume Profile, another crucial tool to understand where the money is going, to assess market structure, to individualize auction moments and the best areas of volumetric support and volumetric resistance. So this is a daily volume profile, okay? And as the word says, it's the profile of volume. So volume by price tells us how much volume was traded per level of price, how much money was traded per level of price, okay? And you can very clearly see there's different types of zones, there's different types of areas, there's different types of colors, and we're gonna go through all of that in this video right now. So the first thing you can notice is there's different colors, right? And you get an orange area over here and a gray area outside. The orange area is also known as the value area. Okay, so the area where most volume was traded. We'll get deep into how much volume was traded exactly in that area very soon. The other thing that you can clearly see is peaks highlighted in purple or pink, and we call them peaks or high volume nodes, okay? And you can see from the volume profile areas where there was a lot of trading activity going on, areas where a lot of volume was traded, right? We call these high volume nodes or peaks. And then you have white areas, right? These guys. And these are basically low volume nodes. So points where the volume is considerably lower than, let's say, the rest. So you have peaks and you have these that are also called valleys. And in general, areas where there's a lot of volume, areas where there's less volume. Okay, and what this means is price and the market itself spend a lot of times into high volume areas and traded a lot of money. Okay, in these areas there was not a lot of money traded. In this area as well, and we call this area the fair value area because both aggressive sellers and aggressive buyers and passive sellers and passive buyers were mostly agreeing that the best price to trade, the best area of price to trade is this one. So what you will probably see from the price action that is derived from this volume activity will likely be something like this. Okay, where there's not a lot of price action going on here, so not a lot of volume being traded around, and a lot of trading volume and a lot of trading activity and a lot of trading being done at these prices for a long time as well. Okay, and this shows you how much money was traded in a single day or in a single session, however you set it. And how the volume is often distributed and the area that is currently highlighted, also known as the fair value area, is derived from a specific number that comes from the normal distribution of probabilities in a sample, or the Gaussian curve, which is also known as the standard deviation, the first standard deviation. And we'll understand now what that is because that's crucial to understand. In most things that we can measure, in most events that we can measure with big samples of data, you will likely see something very similar to this curve, right? And 34% of the samples typically will tend to be within this average range, which we call the first standard deviation. This is the second standard deviation. This is the third standard deviation. Okay? So within the first standard deviation, you will see 68%, around 70%, let's say, of the samples. Within the second standard deviation, you'll have 95%. In the third standard deviation, you'll have 99%. And this is true and common and observable in a lot of samples of data. For example, the length of penises. The average length of penises, if you look at the distribution of the length of penises, it will have this sort of distribution, where most of the people will have an average sized penis and a few people will have super small or super big sized penises. This is the distribution of male height, and also here it has this shape, right? Where you have a lot of people in the average area from 165 to 175, very few people above 180, which is 6 foot, around 6 foot, and very few people below that. So whatever we try and measure will tend in nature to have this sort of distribution of probability. So getting back to this, you will have a 68% probability of ending up between this range. You will have 13% probability of falling between this range, 2% probability of falling under this range. So this is where most elements are, and these are where the fewest elements tend to be. Okay? And with the volume profile, we can assume kind of the same, because we can take how the distribution is, all the distribution of volume throughout that day, and we'll see where most of the volume was traded. And we know that volumetrically speaking, money-wise, this was the first standard deviation. And so we also know that whatever happens outside of this range is, statistically speaking, related to the volume traded during that day, an anomaly. And both outside these areas and inside of this area, crucial moments in the action of money and order flow happen throughout a day. Because there's some, tendencies that price or the market will have when you reach these areas of price. So here I have plotted in the chart the volume profile of the cash session, of each cash session. And as you can see clearly, the areas where price spent the most time are the areas where most volume was traded. Okay, a lot of time spent here, a lot of trading activity happened here, and these are the areas where you could expect in the future sessions as well some level of trading activity and reversal from the areas where you get out of a fair valuation. So what you will typically do in any scenario like this is taking the ledges outside of the first standard deviation, and also in the following session you'll see that pretty much those are the areas where you have a higher likelihood of seeing rejections from price. Because if during a specific session price consider these prices to be fair or better, buyers and sellers on the aggressive side and on the passive side consider these prices to be fair, there is some level of likelihood that if we get further out from this fair valuation of the previous day, we will get back inside, trade back inside of it, test the same areas where these buyers and sellers agreed to auction higher until we reach something similar to the previous area, and then back down again, up from here, and that's where we stop once more. So these areas act as a actual support and resistance, and not because price is bouncing there multiple times, but because there is something making price bounce there multiple times, which is institutional interest and money. Now, of course, with the benefit of hindsight, all of the areas are going to work super, super good. So this is, again, not a law, but I strongly advise you to go back in time, and not just go back in time, but also with a forward-looking type of approach. Take these high volume level areas and see how they react. See how price in the following sessions react to these areas. Because a lot of the auction market theory models come exactly for this. We have a fair valuation here. Price opens in the following session outside and fastly, very quickly breaks back inside. The first reaction happens where? Here. Price tries to auction outside of the fair valuation, but the auction is not ready yet. So we jump right back inside. And when we do that, where do we test? Here. And once that auction is exhausted, then we move on to the other side of the value area. Okay? So this is something that you will see happening all throughout sessions, throughout, days and weeks, in the weekly profiles, in the daily profiles, etc., etc. And you will see this happening all the time. For example, this is the previous fair value area. And in the following sessions, this is the area that pretty much keeps the market in check. So this is our area. This is where most of the money was traded. This was where most institutional traders and investors and HFTs and long-term traders were agreeing is a fair price. Session closes here. Following session opens. First thing we do is we auction lower. We bounce right back from the previous area of support, which is our value area. We test it one more time. We reach the other side. There you go. Failed auction one. Tries to auction higher. One more auction. Goes higher. Can't manage to do it. And then you will just see what happens with order flow here. We drop back inside. Almost get to the other side. Test. And then run to the other side. Okay? Next session, we're open inside of the fair value area, which is this one. And another thing, really cool thing you can do is to click and, of course, just click on the volume profile per se. Volume profile, merge plus, and it's going to merge the two volume profiles. So now you have one big fair valuation area, which is more precise, and considering the volume of two sessions, right? Because they were basically overlapping. So when the following cash session opens, you'll see a very aggressive sell momentum that bounces where? Right here. And when finally we break below it, we have a very intense sell auction because of all of the aggression that happens when we get outside of these areas. Because outside of these areas is where the anomalies happen. Because statistically speaking, most of the trading is done here. And most of the selling happens when we try to get outside of here, for example. And most of the buying always happened when we try to get below here, because we are outside of the normal distribution and of the statistical probability that price will stay inside of that area. So whatever goes outside is an anomaly. That's where opportunities happen. An opportunity to buy at a discount compared to the normal distribution, because you are statistically speaking looking at money at a valuation that is outside normal. And so there is always going to be some form of reversion to the mean, either from the downside or either from the upside. And these are the areas where most of the aggressive selling would happen, aggressive buying would happen, and protection from passive participants from the sell side and from the buy side will happen. But whenever we manage to break with strength outside of these areas, well, that's where volume increases and we're ready for a new auction. But before managing to flip the auction completely, where do we test? The same area. Because the same sellers that allowed this to happen are considering these prices premium. So they will still consider them as premium prices compared to the volume, not compared to some Fibonacci, not compared to anything else but money. And we drop down for the rest of the session. We open, we have this as the main valuation of the previous session, even though it was very directional, but look at where you find rejections. Rejections, rejections. Same level, same area. And when we break back inside, we understand this was just a bigger version of this, which is a failed auction. And we understand that once we get back inside, these are the same areas where we'll auction, test, and go to the other side once more. This is the power of volume profile. This is the power of the auction market theory that we will get even deeper into later. And one of the levels that you will find in the volume profile is the point of control. And the point of control is, personally, not one of the, let's say, a lot of people overestimate it because there's some level of randomness, right? There's some level of randomness involved in where the highest level of volume, the absolute highest single tick where most volume was traded does not have, in my opinion, a great statistical reference as much as this, right? Because, it could be here, it could have been this one with a couple more contracts, it could have been this one with a couple more contracts, could have been, this one with a couple more contracts, or this one, pretty much the same, right? So the single point, a lot of people say, yeah, just place a pending order here and sell from the point of control. Yeah, what, that's not, it's not a reliable model. That's not a reliable statistical reference. It could be more random. There's a lot of trading activity going on. There's a lot of algorithms involved in the price action. So I would not consider the point of control itself to be the main statistical reference. What you could argue with, a little bit more, rationality involved is not the point of control itself, but the areas with a volume peak. That may be an area of institutional interest. Yes, absolutely yes. The areas of low volume, though, as well, because those prices were considered unfair. And that's where you see also a lot of reaction from price. So you can have a daily profile just like this one. You can merge them, and then you can have, for example, a weekly profile. There's all sorts of profiles. You could have a deep profile added to your chart. You can put it on volume, on delta, and you can have a composite volume profile. Which basically is going to give you a profile of the entire chart you're looking at. If you do this to look at long-term areas of interesting volume activity, I kind of advise you to go to the plot settings and in the visual appearance, align it to the right. Get rid of the value area and just look at the main areas. Just look at ledges. And by ledges, I mean whenever you see from a big volume spike to a low volume node, you're going to take all of that area, that's your ledge. From a big to a low. And basically whatever is inside could be considered as your value area. When you see sudden drops in volumes, that's your ledges. That's where you see a lot of reactions coming from. And this is pretty much all of the basics that you need to know about the volume profile. We'll get deep into that practically also in the next, sessions. But this is what you need to know about the volume profile. I'll see you in the next video.